Every morning before the open, this system runs a fully automated pipeline. Options chain poll, gamma calculation, AI narrative generation, and a 5-gate validation without any manual input. The origin story and trading context are in the companion video linked in the description. This one is pure engineering. We're going to get into the data collection, the GEX calculation, and how the AI pipeline is set up, how hallucinations are prevented, and how all of it connects into a briefing that runs automatically every morning before the open. Before the pipeline, you need to understand the data model, because several decisions here are deliberately different from other platforms. GEXlog calculates gamma exposure using the nearest expiration, typically the SPXW weekly contracts at 0 to 1 DTE. Most third-party GEX providers aggregate across all expirations. Both approaches are valid, they answer different questions. This system is interested in the same-day dealer hedging pressure. Nearest expiration is the right scope for that question. Gamma times open interest times the contract multiplier scaled by spot squared over 100. The GEX math runs in Python, primarily NumPy for the vectorized strike level calculations across the full options chain, with pandas structuring the chain data coming in from Tradier. Calls produce positive GEX. Dealers who are short calls are long delta and will sell into rallies to stay neutral. Puts produce negative GEX. Dealers who are short puts are short delta and will buy into the dips. Net GEX is the sum across the entire chain. The GEX flip is the strike where cumulative GEX crosses 0, the structural boundary between positive and negative gamma territory. In a deeply negative gamma environment, that crossover never happens. Put gamma dominates every single strike across the chain. When that's the case, the system reports null. I decided not to approximate a number. Null is an accurate output. It means the regime is unambiguously negative all the way down the chain. True gamma exposure requires knowing exact dealer net positioning at each strike. That data isn't public. What this system uses is GEX-weighted open interest, a well-established proxy. High OI strikes with high gamma act as structural levels regardless of precise dealer book data. Directionally valid, not a proprietary feed like spot gamma or squeeze metrics. I don't claim it is. Put wall, the strike with the largest absolute put GEX below spot within a search window of 3 times the expected move. As price drops towards that strike, dealers who are short those puts are forced to buy the underlying to hedge. That buying pressure is what creates the structural floor effect. Call wall, the equivalent above spot. As price rises towards that strike, dealers who are short those calls sell the underlying to hedge. That selling pressure is what creates the resistance. A sustained break above flips that dynamic. Dealers are forced to cover, which can accelerate the move. Pivot levels. R1, R2, S1, S2 are a completely separate system. Classic floor trader pivots from the prior session high, low, and close. No gamma math involved. I display them separately because they're computed independently. When a pivot and a wall land near the same price, that confluence is worth noting. When they diverge, they're pointing at different things. This is the full system. Everything I just walked through, GEX calc, level derivation, regime classification, lives in the Python backend node. I'll use this diagram as the map and return to it between sections. Everything runs on scheduled Python scripts triggered by cron jobs on the server. 5 pipeline runs per day on the weekdays. 5 a.m. Central, calendar sync. Pulls the economic calendar from financial model prep. Fed speakers, CPI, NFP, PCE, GDP, each event with an impact rating. This feeds into the calendar risk score that influences the go, caution, wait signal. 5:05 a.m. Central, news sync. Perplexity pulls overnight context. What happened while the market was closed? What's moving futures? Every query is explicitly date anchored, not relative language like overnight. Relative time references in AI queries can return stale data. The anchor is intentional. 5:20 a.m. Central, morning report. GEX gets calculated from the Tradier options chain. Key levels get derived. Regime gets classified. VIX regime gets labeled. Calendar risks get scored. Expected move gets computed. Then the AI narrative gets written against all the pre-computed data. The dashboard shows data as of 6:20 a.m. Eastern, pre-market structural snapshot, not a live feed. The point is to freeze the context before the open so traders have an objective map before the price starts moving. The pipeline is holiday aware. It reads a market holidays file at startup. If the market is closed, it aborts at step 1. It doesn't burn AI credits generating a briefing for a closed session. 6:40 p.m. Central. Evening report. Reviews how the session played out versus the morning forecast, then sets up the next session. It recalculates GEX using the next expirations chain, which can be significantly different than the morning's 0 DTE chain. That distinction matters. The evening report does not have a holiday guard. Evening output after a holiday is still useful as next day pre-market context, so the skip logic intentionally doesn't apply there. Output of every pipeline run is a structured JSON file. Morning, evening, weekend. Each its own schema. PHP reads these files to render the dashboard. The AI does not touch the dashboard directly. It writes to JSON, PHP reads it. One subtle detail on mutation. The morning JSON gets updated by the evening run. The quote refresh overwrites certain fields with end of the day values. Any field that needs to preserve its morning value is captured in a separate key before that overwrite happens. The original gamma regime at market open is one example. The evening scorecard needs that original value to compare against what the session actually delivered. This is the part worth being precise about. It's where AI-powered systems tend to fail silently. Let me elaborate about how this one is structured to avoid that. 3 AI models, each with a bounded, dedicated job. Perplexity handles overnight news only. It's source-cited, date-anchored context passed downstream to the narrative generators, not analysis, facts. Both Claude and Gemini generate the morning narrative independently. Deliberate redundancy. If one provider fails or produces output that doesn't pass validation, the other is already there. Gemini handles the evening narrative and the YouTube transcript. The transcript generation receives output from both morning providers as part of the session scorecard. AI is terrible at math, so I don't let it do math. Every number the AI could get wrong is computed in Python before the prompt is built. GEX regime classification, VIX category, expected move, put wall distance in points, call wall distance, calendar risk score, pre-computed, injected into the prompt as hard-coded labeled facts. Instead of asking the AI to compute the put wall distance from the current price, I inject put wall distance 126 points below current price. The AI reads it, repeats it. It doesn't hallucinate what it was given as a hard input. VIX thresholds work the same way, classified in Python before the AI sees anything. That label is injected. The AI does not interpret VIX subjectively. It receives a pre-classified category and uses it. Beyond fact injection, the AI playbook goes through 5 sequential validation gates before it's accepted. Gate 1 ensures the correct keys are used and no empty data. Gate 2 catches fabricated levels. If the AI generates a playbook citing a support zone that doesn't exist within 5 points anywhere in the sourced data, rejected. Hallucinated price levels don't survive Gate 2. Gate 3 is the regime coherence check. Positive gamma means mean reverting range-bound conditions. If the AI outputs ride the breakout momentum in a positive gamma environment, that fails. The gate enforces this mechanically. Gate 4 is a hard content filter. Naked puts, naked calls, undefined risk positions. If any forbidden keyword appears, the playbook is rejected regardless of everything else. Gate 5 kills filler. Stay alert and watch price action closely. With no name structure, fails actionability. The output must commit to a specific strategy type. Here's what that actually looks like in practice. The AI generates a playbook. Gate 4 catches a forbidden strategy recommendation. The system flags it, rejects the output, and the dashboard falls back to a programmatic default. The report is never blocked, it degrades gracefully. The system doesn't trust the AI, it verifies the AI. One more layer, the evening scorecard. Every morning, before any mutation happens, the pipeline archives a frozen snapshot of the forecast. Regime call, date type prediction, key levels. In the evening, the actual session outcome is compared against that frozen state. The YouTube transcript AI receives both the forecast and the actuals. It's required to lead with accountability if there was a miss. The prompt enforces that structural explicitly. It doesn't get to bury a wrong call. The regime panel at the top, positive, negative, or neutral gamma. The go, caution, wait signal is derived from 3 inputs: gamma regime, VIX classification, and calendar risk score. A positive gamma regime can still produce a caution signal if VIX is elevated or a major macro event is on the calendar. Key levels: R1, R2, S1, and S2 are floor trader pivots, pure prior day OHLC math. Put wall, call wall, and GEX flip are options derived, displayed separately because they come from completely different systems. Expected move: VIX divided by 15.87. That's the annualization factor that converts VIX from a yearly volatility reading down to a single day range estimate. Price exceeding that range intraday is a meaningful signal. The morning narrative, synthesized by Claude, grounded in the pre-computed facts I walked through earlier. There's also a raw data tab here. This is the actual structured JSON the AI was given. information, every pre-computed fact, every injected label, every level and classification that fed the prompt. If you ever want to check what the model saw before it wrote the narrative, it's all here. The Trades tab. After entry, a background sweeper scores the position against the current day's regime data. Green, structurally aligned. Amber, elevated risk. VIX has moved or the position is now exposed to a macro event. Red, misaligned with the regime. The detail modal has the full AI assessment in a frozen snapshot of the market context at entry. SPX price, gamma regime, VIX, GEX levels, calendar risk, that snapshot is locked. The live market keeps moving, the trade's structure context at entry doesn't change. Each trade includes a visual strike diagram, position structure, expiration, price relative to the wings. The Analytics tab. Performance sliced across multiple dimensions. The question, does Go actually outperform caution days? Does positive gamma produce measurably better results for short premium strategies? That's the data that validates or invalidates the framework. The Historical Archive Viewer. Every day the morning pipeline runs, it saves a pre-mutation snapshot of the day's data before anything gets overwritten by the evening run. This viewer lets you browse any past date. Select a date, the morning brief for that session loads. The same layout as the live dashboard, same data structure, rendered from the archive JSON. Toggle to the evening recap tab, and you get the post-session view of the same day. What the forecast called, what actually happened, it's a complete historical record of every briefing the system has generated. The archive is public, no login required. Anyone can go back and audit the calls. A few hard constraints worth stating directly. Not a trade signal service. Go is a session character classification. It tells you about structural conditions, not whether a specific trade will win. The AI can be wrong. Hallucination guards, validation gates, fact injection, they reduce errors significantly, they don't eliminate them. Verify critical levels against primary sources. GEX is a proxy. Dealer positioning is not public data. GEX-weighted open interest is a well-established approximation, directionally valid, not a proprietary institutional feed. Performance data is model-based, theoretical entry and exit values. Real slippage, fills, and commissions introduce variance back-tested numbers don't capture. Not financial advice. On the roadmap, trending, streak data plus visual widgets on dashboard. AI pipeline refinements from production edge cases. Additional analytics dimensions. Daily briefings. If there are features or methodology details you want more depth on, drop a comment. The roadmap is partially shaped by what the channel asks for. The briefings run every weekday morning before the open. The origin and companion video is linked in the description. Drop a comment if there's anything you want to see. If the GEX log gives you a daily edge, don't forget to like and subscribe to get the brief in your daily rotation. Level set, bias defined, good luck out there.